This segment covered several topics, such as the alternative minimum tax, minors and dependents, estimated tax, FICA, and the tax penalty that was part of the Affordable Care Act. We learned that the alternative minimum tax was designed to inhibit higher income taxpayers taking advantage of tax loopholes and paying lower taxes. It accomplishes this by removing many deductions allowed on a standard tax return, through computing the alternative minimum tax. We covered the definition of a dependent, as well as tests to help determine who qualifies, and we defined qualifying children or relatives. Two of the credits claimed for children or dependents are the Child Tax Credit and the Child and Dependent Care Credit. We also discussed recent changes intended to increase the amount of child care expenses that can be claimed on individual tax returns, as well as to transform what had been a non-refundable tax into a refundable one. Estimated taxes are paid by individuals, sole proprietors, S-corporations, and those in partnerships who expect to owe $1,000 or more when their return is filed, and there are penalties for paying these late or incorrectly. They're paid quarterly, in April, June, September, and January of the next year. The amount paid is typically based on the previous year's income tax return, although in some instances it's a better idea to base it on estimates of the current tax year's earnings. We also explored FICA tax and how excess FICA is handled. FICA stands for Federal Insurance Contributions Act and encompasses Social Security programs as well as Medicare. FICA is paid by both employer and employee, and excess should be adjusted for by the employer or refunded or credited to the employee. The lesson finished with a brief look at the tax penalty introduced by the ACA. In an unusual situation, this is a tax penalty that still exists, but since it's set at 0, has no practical impact at this time.